Welcome to Joe's Happy Hour, a show about markets and life hosted by Joe Fahmy. This podcast is for informational and entertainment purposes only and should not be regarded as personalized investment advice or relied upon for any investment decisions. Joe Fahmy is an employee of Zor Capital, and he and his clients may maintain positions in the securities discussed in this podcast. All opinions expressed by Joe are solely his own and do not reflect the opinions of Zor Capital. The views expressed by guests are their own, and their appearance on this program does not imply an endorsement of them or any entity they represent. Thank you and enjoy the show.
Phil Soussan.
Hey.
How are you?
Joe Fahmy, I'm back.
You're back. Welcome back.
Yes.
I think you were my second episode.
I know. It became a legendary episode.
It was, yeah. We're almost up to 30, so I didn't think I'd make it this far, but I appreciate you being back here.
Well, congratulations. That's pretty good, right?
Thank you. Yeah, try to get through 50 in a year and see what happens. And maybe Spotify might come calling. Who knows? Quick introduction for people who did not see you the first time. And legendary musician. You're dressed like a rock star. You look like a rock star, if anyone didn't know already. You've worked with Ozzy Osbourne, Last in Line, Vince Neil, Billy Idol, many band, Dawkins, Toto. You wrote the song Shot in the Dark for Ozzy Osbourne. That's what's one of your claim to fame.
Yep.
And I always like to, and also VP of the Grammys in 2011 for 2 full terms. That's a fascinating...
Yeah, the Grammys is, everyone thinks it's just the show, but it's not. There's another 364 days of the year. And so there's a lot of things that the Recording Academy does. They do advocacy, they do archiving and preservation, they do music cares, they do the awards show. So all of these things go every single day throughout the year. And then the awards show comes around.
Yeah, I'm sure there's a lot behind the scenes. Everyone just thinks of, it's a once a year award show, but there's a lot more to it.
Yeah, I mean, to me, the awards show is probably the least interesting part of it.
That's fair. But I always want to let the guests introduce themselves because if there's anything I might even left out, or I forgot to say avid investor. I feel like 99% of our conversations come down to the stock market anyways, and we have a lot of great conversations about that as we did the first time around. But anyways, I'd like you to introduce yourself.
Absolutely. I mean, we'll run into each other in music clubs and, hey, so what's going on in the market today? We'll start talking about the market, and in the background there's a band playing. You know?
And sometimes you're playing on stage.
Yeah, can you guys keep it down for a second? We got some important things here. Yeah, I mean, what else? I think you've covered everything. Thank you very much. It's a very gracious introduction.
Yeah.
Thank you, Joe. But yeah, playing music, I've been doing it my whole life. I'm also somebody who's a bit entrepreneurial. So I've owned a restaurant. I've had side businesses. I had a consulting company for professional audio. A lot of the equipment that you see here.
Yeah.
Workflow consulting. That was interesting. I did that for a long time. So I try to delve into lots of different things. Bob Hope was an actor, but he also had a lot of other businesses.
That's right.
And I think there's a good lesson to be learned from that. You make a little bit of money in doing what you love doing, and then you parlay that into other things.
Yeah. If you are entrepreneurial and you have that desire, and it's even the Warren Buffett, multiple streams of revenue. Yeah. If you can create that. That's a hard thing. I mean, I think everyone would love that, but that's a hard thing to achieve.
It is difficult to achieve, but I think it is very important for people who are in the entertainment profession. Because in our business, it's feast or famine. 1 year you make good money, next year you don't.
Yeah.
And the secret to navigating that is to keep an even keel, if you pardon the pun there, but it's to keep an even keel. And so not to change your life too much under feast and neither under famine as well.
A lot of people think that the rock star life is the rock star life of the 80s and 90s and everything's, and I have a lot of friends in my non-music friends just assume everybody is, on stage and rocking and album sales and touring and all, but there's a lot of misconceptions about that. Like you said, it is feast or famine.
Yeah, as far as the income and revenue goes, of course there is. But even the lifestyle, I mean, some people probably think that, I get out of bed and my rock star clothes and like, play air guitar down to the kitchen to make coffee. But if you ask my wife, she'll tell you that's not how it is. We're pretty normal at home,
Yeah.
So you tend to leave that stuff on stage. But sure enough, I mean, the money comes in, and you want to make sure that you find some way to preserve that and to mitigate and navigate the economy.
Yeah.
And the economy is about paying your bills, and it's about paying your rent or paying for your mortgage, or it's your living expenses and your health. And I don't need to rattle it off, but these are all things that are very, very important. And they don't always go in perfect alignment with a career in the music business.
Yeah, I noticed with a lot of musicians, athletes, especially at a younger age when you're just having fun and sometimes the money comes easily, they don't think about the future. I mean, how many athletes have signed $20, $100 million contracts and are bankrupt?
Yeah.
And even musicians that have, had great scores early on, but, have struggled. But that's not just those two vocations. It's everybody. A lot of musicians come to you because they know you've done well and you're, one of the wiser ones. What's your advice, or what do they usually come to you for, and what do you usually tell them?
Well, I think everybody wrestles with the same thing, which is basically inflation. Inflation, that the price of living and cost of goods goes up over time, and you have to have some way to protect yourself against it. I think that's what it boils down to, because you save your money. So you make some money, you save your money, but you want to make sure that money retains some of its spending power. You can't just stick it under a mattress, or if you did, then it's... I think you mentioned Warren Buffett when he started investing. I think he said that the value of a dollar from when he started today is something like 3 cents or 4 cents.
Yeah, it's like down 90-something%. I've heard that.
Yeah. So I mean, somehow or other, this cumulative inflation, which is considered to be normal at 2%. Who came up with this number?
I don't know.
2%.
They just pull it out of there. I don't know.
Why should there be any percentage of inflation? It should be acceptable. It's not acceptable, but at 2%, well, I don't know. Maybe it started because, who knows? I'm just going to guess here, but if someone's mining gold and you are on a gold standard, then effectively that would be diluting the value of the currency. Maybe.
Correct. Yeah.
So maybe the amount of gold that was mined would bring down the currency value 2% a year. Maybe that's where they came up with that yardstick.
I don't know where that came. That's their goal, is to 2% is okay, I guess, enough. But it's not 2%. It's maintaining that, but people forget that when it jumps up as it did during COVID, now it's 2% from a higher level. So it's
cumulative.
It's cumulative. So
yeah, it's the opposite of Buffett's eighth wonder of the world. It's compounding interest, right? It's compounding inflation.
Yeah, I know. It's astronomical. So when people come to you, is it usually asking for advice, or is it just, again, life costs money, bills, like you said, and it just seems to, out of nowhere, you have to repair your roof, or a car repair, or a kid wants to go to some, camp, and it's like this stuff isn't cheap anymore.
No, no, it's not. So the whole idea of keeping up with inflation is, I think, participating in growth. So there was a great story, of course, when Volcker decided to double interest rates from 10% to 20%.
Yeah,
right.
Back in the 70s,
right? In the 70s,
yeah.
and to address slowing down the economy back then. It sounds like a lot, 10% to 20%, but at 10%, people were mitigating that 10% interest rates, and so they saw a doubling of interest rate, and somehow or other, the country was able to take care of that. And why? I think because there was quite substantial growth that was taking place.
Yes.
Compare it to recently, where we've had a few decades of very, very low interest rates.
Yeah.
And then all of a sudden we've gone from 0.25% to 2.5%. Going from 0.25% to 2.5% is not doubling. That's 1,000%.
Yeah. No, even though it went from roughly 0 to 500 basis points, it was never been raised that much in a year.
Quite.
In the history of the market.
And Yeah, when you look at it
percentage-wise,
percentage-wise, absolutely. So this was a shock to the system, and it's going to be very difficult. But the growth of this country, growth of our industry, growth of business is how this gets mitigated. And you can not really participate in that unless you are involved in the markets. So if you're involved in the markets, then you can participate in that growth, and that will help you mitigate the natural inflation, increase of prices, and devaluation of money as you go forward. So sometimes people say, I don't want to be involved in the markets. I don't want to be in the stock market. You lose everything. You know, people have lost everything. I know people who have lost everything. Yeah. But the fact is, you are actually participating in the growth of the economy, the growth of businesses, the growth of the company. So it really is important to get into it. And I try to give people a bit of a sort of introduction, how to start, what they can do, how they can start. You know, sadly, the biggest benefit is time. And so many people kind of wait until it's a little too late, and then they try to play catch up.
Yeah.
Ideally, this is stuff that should be taught at school.
Oh, yeah. What's the thing? If you put aside like $50 a week at age 20, it turns into like $2.5 million or something like in the S&P or something by age 60. Something like that. Again, compounding.
Yeah, it was.
I just made that up, but no, it's actually I forget if it's $50 a week or $100 a month, something like that. At age 20, by age 60, if you put in the S&P, it turns into 2.2 or 2.5.
Yeah, I think Peter Lynch in one of his books talked about saving $10,000 by the time you were 20 years old, and investing it at a particular modest rate.
Yeah.
And never adding anything more to it, and you'd end up with 1.4 million by the time you retired.
If you never even added,
if you never even added to it. So
the power of compounding.
Right. Yeah. And he did write a fantastic book called Learn to Earn.
Yeah.
Which is a very readable book for kids, for younger people. I sound like an old person, don't I? I'm talking about, because, you know, a kid's like, I don't know, 16, 18 years old, doesn't want to hear about this stuff. But the book was very readable, and I think it was an excellent introduction. I've given it to lots of friends of mine's kids and stuff. Said, hey, read this; it'll be priceless. So
yeah, it's one of those things where I think people don't. Again, when you're younger, you just want to have fun. You want to play outside. You want to play the guitar. You want to, go to the bars, whatever. You're not thinking of the responsibilities until a house, kids, family, all that stuff. And then, because you don't have those bills when you're younger. So you're not thinking about it.
Right.
And then when you get later, then you're like, okay, I need to save, because if I don't want to work my whole life, I need to be able to put some aside. And you're right. Some people start too late, but I don't think there's anything is ever too late, as long as you're doing something to put something aside. But
no, absolutely. The best time might have been a certain time. The second best time is today.
Right. Yeah. But the part about I have people just come up to me and say they're just very intimidated about getting into the markets. And I've had some people say, oh, my family lost this, or my dad lost whatever. It's a friend lost everything. But that's usually because they're buying some penny stocks. They're not putting it into an index or something that goes up over every 10, 20, 30-year period. But anyways, they come to me and they say, I don't even know where to start. I assume too much, and I think I assumed that, just open a brokerage account, put some money in, and buy a stock or buy an index. But to me, that's intuitive, because I've been doing this my whole life, and I forget. I'm sure when some musicians come to you, they're almost too embarrassed, but that's actually a very common question.
Well, you have to hold their hand through the process.
Yes.
I mean, through the very, very simple, basic stuff. Open an account, fund it, actually put some money in there, and it's a little bit like, what's going to happen to that money? Well, it's nothing. It's like a bank account. It's like a holding account.
Yeah.
You put the money in there, and if you don't buy anything, it just sits there.
Yeah. You
can take it out too. So, just look at it in those terms. And then when you want to go ahead and start making some investments, then you can take the money out of that.
But that's very intimidating for a lot of people.
It is intimidating. Yeah. That's my point.
Because like your point, okay, the money goes into a Fidelity, a Schwab, or whatever, one of those online brokerage or whatever, Robinhood, whatever, and then what does it do? Where does it go? Like, they think it's just going to evaporate, even though it's sitting usually in some money market sweep or something like that. Usually.
Yeah, you want it to evaporate, stick it under your mattress. It'll evaporate really quickly.
The maid will find it.
Well, it'll just devalue. I mean, somebody sitting on a bunch of cash versus taking that cash and buying gold coins in the last 3 years. I mean, look at that, right?
Yeah, but some people are just, I think their views on the markets depend on, I've always said, depends on what your parents might have gone through.
Yeah.
It also depends on the period you grew up. So I started from 95 to 99, and that's why, I'm not saying I'm always bullish, but I'm looking for like that next stock that could go up 100, 200, 300%. I'm fascinated by that.
Mm-hmm.
If you grew up and all you knew was 07, 08, 09 financial crisis, global financial crisis, and you saw the average, I mean, the averages went down 50%, but a lot of financial stocks, oil stocks, or whatever, went down 70 to 90%. If that's what your first exposure was, that's what you think the whole market is.
Yeah.
My first exposure was, I guess, thankfully, an amazing time. So that's why I'm always like, people are like, why aren't you shorting? Why aren't you bearish? I'm like, I might be cautious at times, but I'm looking for the next, .com that can go nuts. Yeah. And so that's my time frame that I started. If you started in 1929, you hate the stock market.
I don't look that old, do I?
No, not you. I'm saying if someone did. I'm just using an extreme example of if someone invested in, that's way too old. But that's if someone invested or was exposed to the markets during a horrific time.
Yeah. I think we covered this the last time I was here, but I started right in 1987, right before.
You did. Yeah, I remember that. Yes.
Yeah. So that was... Yeah, fantastic.
But you're still optimistic.
Of course, I'm optimistic.
Yeah,
yeah, I'm optimistic. I learned some lessons as well, and some of the lessons I have learned are to take a step back from everything, and to think rationally and not to panic.
Why would you do that?
Why would you do that? Really,
you're making too much sense.
You just try to keep your head. Try to keep your head when everyone else is losing theirs. I mean, we had a great example of that in April.
Yeah.
Right.
So let's talk about that.
Okay.
Tariff scare.
Tariff scare.
Yeah.
Oh my goodness. So the tariff scare. Hold on. We had one exactly the same 4 years prior to that, didn't we?
We did.
Okay. So we could always go back and kind of refer to that and see kind of what happened.
But this one was, people were like off the wall crazy about this one.
Why?
I think politics, that's another Warren Buffett quote. If you mix your politics with your investing, you're making a big mistake. So if you like or dislike whatever the political regime is, that adds to your emotions of like, screw this guy or screw this girl or whoever's in charge.
Mm-hmm.
So again, the elephant in the room, if people don't like Trump and they look at it as how many people told me this guy's crashing the markets. I hate this guy. Yeah. So it adds to the emotion and this thing's going to zero. And I'm like, throughout history, you've seen the graph that goes straight up with all the World War I, World War II, and everything, presidential assassination, all the stuff that's gone on, Vietnam War, and it still goes up. But this one's the one that's going to take us to zero because their emotions from politics, in my opinion, really added fuel to the fire. Yeah, that's my opinion, but I'm curious what you think.
Yeah, I have a chart which I have above my desk.
Yeah,
and it goes back to 2008, I think 2007. I might have sent it to you, and it shows the S&P. It shows the biggest crashes in the S&P. I think there's about 20 or 25 of these. The biggest percentage drops. How long it took to recover. The cumulative total of the S&P. That's the mark of the S&P.
Yeah,
going through time, and the best part of it is the headlines. The headlines are hysterical. Fear of this, fear of inflation, fear of recession, fear of inflation, fear of recession, fear of global collapse, fear of tariffs, fear of this, fear of political unrest in the Sudan. It's like all of this stuff, and that one number, which is the S&P, keeps going up the whole time.
Right.
And so it forces you to take a step back and just say, hang on a second. Hold on a second. Is this just the fear of fear itself, or is this really founded on something that can be incorporated into some kind of rational calculations here? And when you see the S&P drop down with 485 or 480, whatever it went down to.
Yeah. Oh, and the SPY. Yeah.
Yeah. The SPY went down.
Yeah.
And this was, okay, I'm going all in here. And I did. I bought calls. So I bought calls in...
You bought calls.
Calls.
Okay. All right.
Coles.
No, I thought Kohl's like the department store. I'm like, why'd you do that?
That's my accent.
No.
So I bought Coles.
I'm kidding. All right. No, so you bought
Yeah.
call options on an index or stocks or everything?
On the SPY.
On the SPY.
Yeah.
How far out did you go?
July and then August.
Okay, so you did this March, April?
I did this April.
Near the lows. Okay.
Yeah, it was mid-April.
Okay.
So I was buying 500 strike calls.
For July and...
For July. And then later I added some for August.
For August, okay.
And then just, rolled them up. Anytime you're doing those things with calls, you have to kind of roll them up because you want to take the money off the table.
Yeah.
And keep rolling them up. And yeah, loved it.
That's great.
And I don't need to be too cute. I don't need to be too clever. I'm not sitting there trying to find where's the diamond in the riverbed here. just the SPY. Keep it simple.
Okay. When you this opens up a whole bunch of questions. So you mostly, though, I consider you more of a value type of longer term investor in some of your stocks.
Yeah, I have a model, and I usually would encourage anybody to have a model because having a model forces you to be diversified and it forces you to have some protection. Yeah. So I'm not throwing everything in there. I'm not looking for a penny stock and I'm going to sell, bet the farm on it. There's a small percentage of the funds that I have, which I will play with, but a lot of it is in very, boring stuff.
Yeah, because I didn't want people to think like, oh, this guy's some gunslinger buying calls. Like you are responsible. You have a lot of great companies. I would say more value-ish type, and you're doing option strategies around those stocks as well. But I'll let you explain.
Yeah, I mean, 30% of the whole model is in a dividend portfolio.
Okay.
And right now there's another 22% has been in good old T-bills.
Okay.
I mean, was it T-bill and chill?
Right. Well, to your point, for 15 years they didn't pay anything. Now you're getting a decent
risk-free. Thank you very much. I'll take the.
What duration do you usually go with your T-bills?
I've been going very short term, 3 months.
3 months, 6 months. Okay.
Yeah, because throughout this whole process, it seems that there's so much uncertainty that you don't want to lock yourself into too low of a rate.
Okay.
So you might want to. I mean, but the banks did that.
Yeah.
Right.
Yeah.
That's what caused the collapse of some of those banks. They were probably locking themselves into
with some of the regional banks a while back. Yeah, yeah.
Locking themselves thinking, oh, great, we got 2%, 2.5% for the next 10 years.
They went longer term.
They went longer term, and all of a sudden they locked themselves into a lower rate. They could have, while everyone was making double that rate on the short durations.
Yeah.
So, the time to lock in long-term rates is not when you have that kind of instability or just inverted curves and stuff like that. It's
when do we not have instability?
Okay, sorry. I'll take that back. I meant the instability with the inverted rate curve and stuff.
I guess if you watch the news, there's always instability.
Yeah.
I'm trying to watch less of it these days.
And it's funny because it really doesn't change the world, does it?
Whether you watch it or not. News and noise, and notice how news and noise sound the same.
I like that.
And they're spelled very similar letters. I always say you don't turn on the Weather Channel when it's 75 and sunny outside. You turn the Weather Channel on when there's a hurricane, tornado, or blizzard coming.
Yeah.
And people are like, someone the other day said, aren't you worried about CPI on Tuesday? And I said, seeing that I didn't know there was CPI on Tuesday, no, I'm not fucking worried about it. Like, I'm not saying I'm complacent. The news is there and designed to scare people.
Yeah.
What about this? What about this that's going on? There's always wars and geopolitical crap and all that stuff. What about this report coming out? And I just say, look, I need to keep it on to know what's going on. But if you know it's designed to scare you and to promote fear, to get ratings and sell commercials, then you take it with a little bit more of a grain of salt than really stressing out over the news.
I'm writing a solo album right now, and there's a song on there that I'm going to send you because this is exactly what the lyric
what it's about.
Is all about. It's amazing. But but getting back to this, I think that, look, when there's panic that's going on, again, I do not advocate betting the entire farm on anything, but just taking a small amount and making a small bet. Chances are, if the market is down that far, that it's going to recover at some point. And one thing that's kind of a little disturbing about the news is that, I look at the SPY coming down in April, and all of these talking heads on business channels saying, "Oh, it's disaster, disaster." I'm even big bank CEOs saying it's. Yet every time it drops down, it spikes back up. So somebody's buying this, and it's not little retail guys like me. So someone is buying it, and it's causing it to go up. So I wonder how much of that is really manipulated. And when I say manipulated, I just mean people saying one thing and then diving in.
Doing the other.
Yeah. Someone's buying it.
I also think besides the politics, it's recency bias too.
Mm.
When things are really bad on the news and you're affected by that mentally, you're just like, all you see is things go down and you forget that spring is around the corner. And like Peter Lynch said, we've had 30-something bull markets and 30-some, whatever the numbers are. I forget the numbers, but recessions and booms and bull markets and bear markets. It's called the cycles of the markets. Just look at any chart longer term. But when you're in the middle of it, all you know is everything's going down and your emotions take over. So the recency bias is, what do you mean we're going to have another bull market again? This sucks. Everything's going down. This is never going to end. And then the flip side, when things are going up, people are like, what do you mean take profits? What do you mean take some off the table?
Yeah.
What do you mean this is just going to go forever? So one of the things I like to do when I talk to people is remind them, don't let the lows get too low and the highs get too high.
Very true.
Remember, when we're in corrections or bear markets or recessions, whatever you want to call it, that's part of the cycle. And spring, summer, a euphemism for a good time and a boom will come again. And when things are good, there'll be a growth scare and a slowdown again and a recession again. And so it's just cycles of the markets. But when you're involved in it, all you're thinking about is what just happened. So some of those talking heads were just probably freaking out because it's also the velocity of how quickly things were going down.
Sure.
Yeah.
But, having a level head and sitting back. And I'm a big believer in trying to keep your emotions under control when you're dealing with markets, because people can get very passionate about it and very upset about it and very panic-stricken about it as well.
Yeah.
And sometimes my favorite expression is to take a step back. Take a step back and just try to see things from a bigger picture.
Yeah.
And really ask yourself, is this really the end of the world as we know it?
Well, the other emotion, which is the obvious one, I forgot when I said why it was this tariff scare created a heightened emotion besides the politics and the velocity of but people are also losing money. So that, triggers emotion where I might have to work another 10 years if this doesn't come back, or, so losing money is also another factor. How do you keep a level head when you have a balanced portfolio, but it's still...
You don't lose anything unless you sell it.
That's true.
You take the loss. So no, I wasn't taking. Yeah, it was painful for me as well. I'm watching this go down. I'm watching it as a percentage basis going down.
Yeah.
And you see that drop, and you say, hold on a second. A dear friend of mine sent me a little meme today, and he said, if your life isn't full of ups and downs, you're dead. That's life. It's ups and downs. And you can't have the good times without the bad times, and vice versa. But it's keeping a level head.
Is there a Led Zeppelin song about that? Good times,
probably,
bad
yeah,
times, something like that.
Yeah. You're pulling the music quotes out now, right? I should be doing that. But you have to, you have to understand that things. I actually get more nervous when something goes parabolic. That's when I get nervous.
Okay.
I start seeing something going up and up and up and up and up. I had Roblox for a long time.
Okay.
Bad situation. Held it. I had a few hundred shares of it, and it was just like this, it was a pain in my backside. And eventually, I had some option positions on it, and somehow or other waited long enough and managed to work myself out of it and came out with a small profit. And I was like, this was great. This was really good. I think.
Then after you got out,
I got out of it, and then it started going up again, and I was going, oh, wow, okay, it's going up. It's still negative PE, but whatever. It's still, it's another thing we can talk about, how you value something, and then all of a sudden, the irrationality when everyone starts piling into it, that all of a sudden the valuation doesn't matter.
Right.
Targets don't matter.
Right.
Numbers don't matter anymore. It's just going up. And
why go to business school?
And and I saw somewhere, I think Mark Schmel has been hot on Roblox, And so I thought, I'll take a look at it. 122, 124. I was like, whoa,
Yeah.
what happened?
Yeah, no, that happens. The emotions of if you don't get stopped out of a stock and take a loss, you can get worn out of a stock. I'll tell you a really quick story.
Yeah.
A friend won a poker tournament and loved SoFi years ago and put in like 400,000 into SoFi in the 20s. And it went down and kept buying and buying and buying and swore by it. Long story short, he had $1 million or $2 million involved in it, but it just for 3 years sat between single digits. And he swore by it. His average price was 13. He just finally just threw in the towel when it got back to 13, said, I'm getting out at even, and then it doubled after that.
Right.
That's just the way the market, where psychology plays in with people, because if you're buried in something, you might love the story, but you're just like, you say that prayer, just get me out at even, and I'm happy to get out.
I had a big position in Chinese stocks, Alibaba, PDD, that kind of stuff. And for a while it was working very, very well. And then it went through a real stagnant period over the last couple of years, I'm sure.
Oh, so you had them from years ago?
Yeah.
Okay.
And I sort of switched them, and I use a stock replacement therapy, where I basically, cashed it out and then replaced the positions with
in the money calls, or
no. Sometimes I would do it with calls. Sometimes I would just do it with out of the money puts by selling them. Right.
Oh, okay.
Yeah.
All right. I didn't mean to interrupt. Yeah, that's a good. Yeah.
And then that way I could sort of chip away at the cost basis going forward. And these things, I mean, I would roll these things I've been rolling for almost a couple of years.
So you'd keep the stock and write puts?
No, I got rid of
You got rid of
stock.
The stock and just wrote puts?
Short puts.
Okay.
And then what I was doing, so effectively it's a bullish strategy.
You're willing to buy it if it goes down.
You're willing to buy it.
Yeah.
Or you can roll it forward, or if you get assigned it, then you can play a wheel strategy on the stock that you have assigned.
Okay.
And just playing around. And sure enough, after a couple of years, all of a sudden, we had a really nice surge at the beginning of this year in the Chinese stocks.
Yeah.
And they all went, oh, they all worked out very nicely. So managed to close some of those positions, but I'm still holding some of that stuff as well. So, one day it's this group of stocks is doing well, and this group B is doing not so well, and then that reverses. It never all goes up at the same time. But when I do see something go parabolic, then I start to get nervous, because I say, well, okay, now what am I going to do here? I might like my position. I might like the way that I've been managing that position. Maybe it's time for me to get out and leave the well, or maybe it's time to, at least sell some of it. I feel that way right now about, if I'm right or if I'm wrong, but about NVIDIA. It's definitely, it was $4 trillion market cap, is that right?
Yeah, first company to crack $4 trillion like a week or two ago.
Yeah, what's happened in the last year at the company,
The spend in AI, though, that's part of the reason is when you had, so during the tariff, what really launched us was May 1st, the night before Microsoft and Meta announced earnings. And people were worried about the slowdown in AI and the growth scare and all that. And even in the middle of the tariffs, in the middle of everything, they came out and said, not only are we spending, but it's full steam ahead. And even you've heard Meta paying 100, 200 million, like baseball, like signing bonuses to AI engineers and special people who are talent. So, and Zuckerberg literally said this past week, it's something about like hundreds of billions, whatever the numbers were, it's astronomical. So I think that's why NVIDIA is going up, because no one is talking about slowing down their spend in AI yet. That's why I think it's, and until, Amazon has some chips, AMD has some chips, like a lot of people, even Tesla, and Musk is working, but Musk says, we're working on AI chips, but they're nowhere as good as NVIDIA's. Yeah. So I used to work a long time ago, like in a prior lifetime, for a software database company, and they said, we competed with Oracle, and some of the statistics bench test against Oracle were better, but there was a line, you can't get fired buying Oracle's database. So even if other database companies were faster and all this stuff, but the line was, if you're an Oracle DBA database administrator, or if you're a company's IT manager, you can't get fired for buying Oracle, just like in the 90s for buying Cisco stuff. So the analogy is, you can't get fired for buying NVIDIA stuff. What are you going to do? Buy like or I mean, yeah, Amazon has a chip, but it's nowhere close. So.
Yeah, no,
Anyways, I'm rambling.
I just think that with such a huge spurt in that price, that you do have to take a little bit off the table.
I'm not saying like it can double from here. I'm not saying that. I'm not saying it's going to have the insane returns from the past. I'm just kind of not justifying, but sort of, I don't mean to say explaining. It's just my read on it is all of these people, whether it's Ellison or Musk or Zuckerberg, all these, whatever, Mag 7 CEOs, they're basically like, we're not slowing down our spend.
No.
So,
well, there's going to be some growth there, and some people are going to participate in it. But I think the smart thing is, again, you buy in a little bit, you liquidate a little bit, take something off the table, say, you know what, I did really well out of this, and I'm happy with my position, and keep writing it up. But
do you reduce so it doesn't become too big of a size of your portfolio?
No, that's called discipline, which I never had enough self-discipline.
No, like let's say it's, I don't know, like a 5% of your portfolio and the stock doubles and you don't want it to be 10% of your portfolio.
Yeah, in a
way. Would you reduce it to be back to 5 so you still can hold some but take some off the table? Or are you just all or nothing? Like when you get out, you get out.
In my view, mutual funds were handicapped by the fact that they had to do this. So a stock that they had, they could only hold no more than 5%, correct?
Some of they're in their mandate, in the prospectus, a lot of mutual funds, to be responsible, they'll say we can't have more than 5% of the
So
portfolio.
what happens is the one thing that they've got that's the winner, they're forced to cut back the holding of that, and that slows down their growth effectively. So I guess hedge funds are not.
Or retail people don't have that mandate.
They don't have that mandate.
You can do whatever you want.
Yeah. So the point is well taken, and I think I should be more conscious of that. But that's not really what I'm doing. What I'm doing is I'm taking a position. I've put some money into it. I'm looking to take a little bit off the table, bring my the amount that I put into the investment down. Or if I'm working with stock, bring down my cost basis. That's really what I'm trying to do. And also, hey, if it drops down, I like the stock, then I can always add a little bit to it as well. Maybe I've got a position of, I don't know, 100 shares. I might sell 25 and then buy back 25 or buy back 50, or then, so we're talking about 20% of the holding, 15% of the holding, 25% of the holding.
Okay.
If I see a huge, boost in the price, I'll take a little off the table.
You mentioned what I don't want to say scares you, but when you talk about you don't like when things go parabolic, what about, are you more worried about when things shoot to the upside or shoot to the downside?
Yeah, both. Shoot to the downside. That's again that you have to cut your losses. You have to cut your losses. The hardest lesson for me to learn was cutting losses, because I don't know if it's I don't want to be wrong, or I just hate the idea that I lost some money.
Yeah, everyone does. We're human.
Yeah,
it
really
sucks. I mean, when you study the best from market wizards, all those best traders and investors, just like in real estate, what are the top 3 rules? Location, location, location. Yeah. The top rules that they all say is cut your losses, cut your losses, cut your losses. Yeah. And it's a finality. It's like, I have to eat it, and I'm taking a loss, and I'm wrong, and it's ego, and it's emotion, and it's everything that, again, we're human.
Yeah, so it's unpleasant, but you have to do it, and you have to find a way to rationalize it. And so the way I've found to rationalize it is I've said, you know what I'm going to do? I'm going to take this loss, because this loss I can apply to my capital gains at the end of the year.
There you go.
And that way it now has a benefit to me. Because if I got to pay the money in taxes, or I have to pay less taxes, and that's going to work. So now it's become more palatable, so I can take a loss.
Okay.
So that's how I do that. Now,
so you justify it that way.
All right. If it happens to be in a tax-deferred account like an IRA or something, you're going to have to find another.
How do you justify it?
You're going to have to justify it some other way.
No, it's not easy. I mean, I've always said managing a portfolio of stocks, whether it's growth, value, dividend, whatever, it's not easy.
No.
It's not easy, because you have to watch the basket. whether you own 5, 20, some people own 200 stocks, which I think is crazy, but you might as well own the index at that point. Some people have FOMO, though, where they just like, oh, everyone's talking about this or TV's talking about this and I have to own it, even if they own 5 shares.
Yeah.
And then when the market corrects, they have a portfolio and they're like, what did I buy? What is this? They don't even know. So anyways, but having a basket of stocks is, managing that is not easy.
Yeah. Yeah, Phil told me to buy coals. I bought coals. I've got tons of coals.
Yeah.
I know nothing about the store.
Exactly. But it's not easy. I mean, that's why I'm an active manager, but I have no problem telling people most people should be indexing and just longer term.
Well, that's another part of the model. The model has between 20...
Oh, yeah. So tell me, yeah.
Models, it would usually have 30% of index, passive investing, index funds.
Okay. So, yeah, please continue with the model. You have...
Well, let's change a little bit because of the T-bills. When the T-bills came up, then this was a really good...
Okay.
It was worthwhile putting a nice percentage of that into the T-bills and getting the risk-free return.
Okay.
Yeah, I mean, if somebody comes to me and says, what can I do? The first thing I'm going to say to them is that they probably should put some of their money into index funds.
A lot of people say that with your first 5 or 10,000, just put in an index. Yeah, and that's another question I get where people are like, how much you need to start, and is it too little? I feel like, I don't care if you start with $100. Start like just put, you can always add a little bit of your paycheck or whatever when you get money, just put a little bit into an index. It's not investment advice. It's just a good way to start to participate.
Yeah.
So you don't just say, okay, what's the next crack biotech or what's the next penny stock, and then you put 10 grand in and you lose it all, and then the people say, yeah, you just lose all your money in the stock market.
Right. So you have a percentage of your model that you can play with or play around with. Whether you want to buy some high beta names, whether you want to, if you have the index funds, you already have the high beta names. But people feel that they want to be more involved in those. I want to actually feel like I bought some whatever. That's fine. Or if I've got a hunch that this company I really like, do that. I think you should have, 5% of your portfolio in gold as well.
Okay.
And recently I was up to 8.5% in gold.
Okay.
Which I would never do normally, but that's because of the growth.
How often are you, what's the word I'm looking for? Rebalancing or?
Yeah, the dividend portfolio would rebalance typically once every 6 months.
Okay. When most people are looking at their portfolio 400 times a day, you're patient to wait for, you might look at it, but you're not like in a rush to do anything.
Yeah, again, if I'm talking to somebody and we've gotten past the, look, you need to put a certain amount of your money into the triple Q, into the SPY, into the IWM if interest rates allow. Once they've gotten past that and they say, well, I want to be more involved, then we can talk about a dividend portfolio, and you can manage that a little bit. You can go find the companies that you like, find a group of 10 companies, maybe, I don't know, between 8 and 12 companies.
Yeah.
You can basically research them yourself. You can go and find...
I don't want to put in work. Why would I do that?
Well, some people are interested. They want to find out about it.
Tell me what to buy and where to buy it and where to get out. That's what most people want.
I used to love Value Line. That was my favorite thing.
I remember Value Line. We talked about this last time. Yeah.
So that was my favorite thing because you could go and there was the book. And you could find all of those companies very, very concise.
Yeah.
And you could compare them one next to the other and say, okay, well, I can see why this looks better, why this is getting a higher rating. But the important thing is you can even go to your dividend kings or aristocrats, find a list of companies, pick a diversified list, and then balance them. Now, how do you balance them? Well, that's tricky. So I've tried to balance them not just by yield, because that doesn't make much sense. I usually balance them by beta.
Okay.
So what I use is beta to do the balance. I created my own balancing spreadsheet in Excel, and I'm gladly share this with anyone who wants it. But what you do is you put in your stocks, you put in a few, you put in the yield, you put in the beta, the amount that you want to invest, and it sort of balances it for you. And so you're balancing your portfolio on beta, which is on safety. You want it to move as close as possible to the market, 1-to-1 to the market. So you want to, you really want to have a beta of about 1, and it's balancing it accordingly. It works very, very well. Every 6 months, you say, okay, it tells you how many of each things you need to sell, how many you need to buy.
Okay.
You can add more money to it, and it'll calculate that for you. And you really are being actively involved in it. And of course, the eighth wonder of the world is that you drip the whole thing.
Yeah.
So you are also reinvesting all your dividends. That is all growing. The dividends are creating more dividends for you. And it works very, very nicely. It takes time, but I've been doing this for a long time, and I've had 2 or 3 of these portfolios, which have done very, very well. I also take care of, like my wife's retirement account as well. She has one of those in there as well. We have the same portfolio, the same dividend portfolio.
Yeah.
And
she's okay with it?
Yeah. Oh, she's very, very happy.
That's
with
good.
It. Yeah.
Happy wife, happy life.
Happy
portfolio.
I'll tell you a funny story how this all came about. And this was years and years ago. I took a home equity line of credit on my house.
Okay.
And I needed the money to do something, and I used X amount of money. I can't remember. I think I used $30,000-$40,000 to do something, and I had an extra $60,000 left.
Okay.
And at a certain point, they said, "Well, if you want to take this money, you need to take it now." And I said, "Okay." So I took all the money, put it into this dividend portfolio that I created, and by the time the whole thing was said and done, not only had it paid, I drafted the payment every month out of that, and after 2 years, it had been paid off. And I ended up with, I think I had $150,000 left.
So you not only outperformed the interest, but you grew.
Yeah.
You saw growth, appreciation in the portfolio.
And I realized how powerful that was, how powerful an instrument that could be. The interest rate on the line of credit was in the 4% or something.
Probably low back then, yeah.
Yeah, 4%, 4.5%. I used the money to do some work in the house. I used the money. The rest of the money, the balance of the money, to create wealth in itself, to pay back the loan, and at the end, I ended up with more money than I had. So I thought this is a really good example. So that's why I'm very excited about that part of a portfolio. And I think people can get excited about that. It's easy to manage. You don't have to mess around with it too much.
But there's a huge factor here where you're passionate about it. Mm-hmm. You're researching companies. We've talked, and you love, you tell me about certain stocks and so forth. You're putting in the time, and it's something you're just, again, passion is the first word that comes to mind. Mm-hmm. Most people don't want to put in the time.
Yeah.
Most people, if they're going to borrow off a home equity line, they're buying a boat, or they're going to go they're not going to be like you're responsible. And I mean this with respect. Like, especially, I have a lot of musician friends that I tell them to put money in the market. They're like, "Why should I do that?" So you're responsible.
Well, again, this was the backstory on why this is important. But if somebody's just sitting there on index funds and on a dividend portfolio that they're balancing twice a year, they don't have to do too much work. Those stocks that they start with, I did this with my little cousin. I said, here's a whole list of dividend aristocrats. Go find out what the companies do and come back with your favorite 10. And they need to be diversified. In other words, you need different companies.
Yeah.
And for somebody in their early 20s, they were quite excited to do this and came back and said, "These are my favorite ones. What do you think?" And I said, "It looks great. You got some energy companies. You got some."
Oh, so he was excited to do it.
Yes, absolutely.
Okay, so that's a factor.
So
if you have that, that's awesome.
Yeah, it's like, okay, I've got some consumer staples. I've got some utilities. I've got some energy. I've got some this. I've got that, and some defense. This is perfect. Some medical stuff.
Wow, that's pretty cool.
It's cool, right?
Future money manager.
Yeah. So there you go. And then I said, now you've got your list. We're going to create a list for you, and we're going to put it in there, and you say how much you want to invest, and this is what it's going to look like. And every 6 months, you look at it, and you don't do anything. You leave it alone. You can add money if you want. If you've got a little extra money, throw a little bit more money into it. And that's how you do it. You start small, and you build it up.
And you're reinvesting the dividends.
You're reinvesting your dividends, absolutely. Okay. Very important to do that.
Yeah.
But that's the best advice, and I think I can give to people in my industry, not just family members, but people who are in the music industry to, start being able to save. Concentrate on music, play music for the love of playing music. This is why we play music. We don't do it for anything else. This is primarily the reason that we do it. And you're going to make a little bit of money. and let the money work for you. Be part of the whole system, be part of the economy, and that way it'll take care of you. You'll grow with the economy. Over the years, you're going to get much more interested in it, and at some point in time, you probably will have that 10, 15, 18% of your portfolio that you want to, play around with on a daily basis or whatever it happens to be. And so be it. You can feel good about it because you've got the lion's share that's responsibly invested, and hopefully through diversification, and you've embraced the first rule of investing, which is risk management.
Yeah,
I mean that's what it's all about, isn't it?
It is. It is. You mentioned valuations, price to earnings earlier. You said we could talk about that.
Yeah.
How they kind of go out the window in a bull market.
Yeah, and it nearly always results in me getting out way too early.
That's okay, though. That's okay.
Right.
I've learned that lesson. Moves in the market go on much longer than we can expect in both directions.
Yeah.
Just when you think something can't go higher, usually does, and same thing. Just when you're in a correction, it can't go any lower. That usually does too. So things overshoot.
Yeah, they do. It's always frustrating to have a position that does well, and then you get out and you think you're being responsible because now it's starting to get a little bit lofty, and then you see it go up further and further.
Yeah.
And so that's why I started really paying attention to taking profits off the top. So that if I want to stay in the position, but at least take your money out of it.
Would you write covered calls on it?
I write covered calls sometimes. I've not been very successful at it. It just seems, I'll give you an example. Win, I've got a position in Win, which I've had for a long time.
Yeah.
I love the stock. I love the as much as anyone should ever love a stock. But I've had it for a long time. I've got a very good cost basis in it. And every time it gets up to about 96, 97, it just pulls back. And so last time I went, okay, hell with it. Got to 94 or something. I wrote some 96 calls on some of the position, and then all of a sudden it starts soaring.
The China news comes out.
Yeah, and it goes 100, 110, and I'm like, really?
It's not for everybody.
2 years, it's never gone anywhere. So I've now figured out that if you want a stock to go up, you call me, and I'll write a covered call against it.
All right. That's perfect. That's good.
There's somebody looking over my shoulder, Joe.
We can make a business out of this.
I know.
If you want a stock to go up, call Phil, write a covered call,
right.
Instant 20% in a week.
Absolutely.
All right.
Because do you ever get a feeling that somebody's looking over your shoulder?
I've been there before. And the funny thing is I've been doing this for a long time, and when I tell people this, they're like, really? This happens to you? I'm like, I get stopped out sometimes at the dead low of the day. I'll sell it, and I'm literally like, I accept I'm never going to get the highs or the lows, but sometimes I'll sell something. I literally am the low print.
Yeah.
People are like, that happens to you? I'm like, oh, yeah, because I'm Superman. Of course that happens to me. But it's not someone looking over my shoulder. Sometimes, you just say, all right, maybe I put my stop in an obvious stop, or I said I'm going to cut my loss at a certain technical level that maybe everyone and their mother's looking at, and then it turns around on you.
Yeah. I've so many people who are, particularly, I suppose, older people who have some wealth amassed in stocks, look to covered calls to try to generate some more income.
Yeah.
And I just don't know enough about it. I'm not good enough to do that. The only place I really write covered calls is if I'm reversing a position that's been assigned to me. That's really where I do most of my call writing.
Okay.
So, for example, if I had a short put position that got assigned to me, and I didn't want to reverse it completely, but I wanted to hold the stock because maybe there's some high volatility. I love looking for high volatility. That's the one thing that I like to do. The one thing I like to do is to look for high volatility stocks, because those are stocks that I can write, juicy puts against. And if they do get assigned, then I can write juicy calls against them. And so I can keep, participating in the theta decay of the options. So that's fun to me.
Yeah.
But just writing the covered calls is kind of hard, as is writing long calls as well. That's a tricky one too.
Yeah. Options is a huge market. I think I just saw over 50% of the options traded every day are zero DTE, 0 days to
I don't
expiration.
understand that either.
Look, it's a degenerate economy and society.
Yeah.
People are gambling on, the most highly watched sporting events. The most highly watched television shows are sporting events because you can bet on them, and it's the same thing in the markets.
I don't understand. I don't understand how that sort of translate. People talk to me a lot about zero DTE options, and some of the better options traders out there use that information as well. But I can't. It's not clicking with me just yet.
Yeah, I don't
that.
really follow it. I'm not against if people want to do it. And some people just want to gamble, and do it whatever you want to do. I just know that that's a big portion of it. The options market notionally has just become huge as far as all sorts of people using option strategies and stuff. But again, I just tell people keep it simple because a lot of people are fascinated by options. I say just learn basic stock stuff and index stuff first, and then again, if it's something you want to do and take it upon yourself to learn, then Investopedia. There's all sorts of educational sites online to teach you about it.
Yeah, people are attracted to the leverage that options provide, of course.
Of course.
But the skill about the one thing that adage that I remember all the time is that 80% of options expire worthless.
Yeah.
So you want to be part of the 20%. If you want the 20% and you really have a firm belief in a company, when I buy calls, they're at least 6 months out, and usually they're at a delta of 75.
Okay.
So they're not cheap. But that allows me time, and it allows me delta to be wrong and to not lose too much money.
Yeah.
And that's very, very important. And most people just go, well, look, I can buy these ones for 10 cents or whatever, and they're sort of way out the money.
Dollar and a dream. People would rather put a bunch of into 10 cents or under $1 option, hope it goes to 20 or more.
Yeah.
That's what the fascination with zero DTE is too.
I suppose.
But time is a huge factor. So giving yourself 6 months is wise.
Yes.
Not 6 minutes.
No, 6 months is wise because you have enough time value left in the option, which represents a great portion of the premium that you've paid for that option. So you may be able to recover that. And then the other nice thing about options, a delta 25, well, options versus stock positions, of course, is if the stock does go down, then effectively the delta is going to go down on the option. So you lose progressively less and less money than if you held the stock itself.
Okay.
Right?
I get that, yeah.
You got $100 share goes down by $10 and you got $90, you lost $10. But if you have the option and you have a 75 delta in it, then you're going to only lose $77.50 and progressively less and less and less if it goes down. So you can be wrong and still recover a great deal of your costs.
Because you're giving yourself time as well.
Yes, absolutely.
I meant to ask you whether you are taking upon yourself when you look up a company or if someone says, hey, what do you think of this stock? And maybe you didn't heard of it or whatever. What's your process in researching companies?
The very first thing I want to do is I look at just a simple table. How much earnings? I want to know how much revenues, sales.
Yeah.
Cash flow, free cash flow. If they're paying a yield, or probably I don't know. If they're paying a yield, then we're probably not looking at that stock. But definitely any kind of cash flow, free cash flow. How much cash are they burning through?
Oh, if they're paying a yield, you are looking at something for a dividend, right?
Correct. But if somebody threw a blind stock,
if someone usually they're
probably
it's probably
a growth stock or something.
Right.
So those are the first things I look at. I'll look at the chart. I'll see if I can spot any obvious technical stuff. I mean, you're talking to a knucklehead over here. I'm still looking. I'm still looking at level 2 trades and saying, how can I possibly use this to improve my trading? I still don't know. But I mean, definitely charts. I look at basic technicals. Look at support and resistance. See what's going on. See what the story is.
Okay.
See what the options are trading. See what the stock volume trading is looking like, and at that point, try to find out a little bit more about the company.
If the fundamentals jive with what you like and fit your criteria.
First thing I look at is fundamentals. So I guess that's the first thing. I mean, a lot of people are just like, "Hey, this thing's really flying. You should jump into it."
Yeah. Oh, sure.
And
Great advice. Sarcasm.
sometimes it says, "Oh, okay, well, I'll take a look at it. I'll see what it is. I'll see what the backstory is. Maybe there's something interesting here. Maybe not." But occasionally something comes up. We've talked about a couple of things that I'm quite excited about that I've been holding for a long, long time now,
Yeah.
which are starting to work quite well. Very under the radar. And a lot of these things, obviously there's no real options market to trade, so you can't play around with them. It's you take a position, you hold a position, and see what happens.
Okay. Like especially smaller cap stuff when the option spreads are too wide or not really liquid.
True.
Yeah.
True. But
I've noticed that with biotech. When I look at biotech, because sometimes I don't want to take the risk. And you'll see, it's not like Apple where the option trades 302 by 303. And it's like at the most a 3-cent spread. It's more like 330 by
there's a huge skew on them.
5 something. And it's like,
It's nuts.
it's like, I'm trying to minimize risk, but I don't want to be down 40% right off the bat buying the option. Even if you try to put in an order to try to get it in the middle, you could be waiting for days. But anyways, it's just...
a friend of mine throws me biotechs, and I'll put a small, tiny little position, and it's just you just sit there and wait to see something happen.
Yeah.
Sometimes it does, and it's not really I mean, that's probably like throwing a quarter in a slot machine as you walk past it, right?
You never know. You could win the car.
You could do.
But biotech, it's also to your point about sometimes you have stocks in your portfolio that are doing well and other ones that don't all move in sync. There's a period when biotech is really doing well.
Absolutely.
Recently, with either administration wanting to lower drug costs, it's just they've been a little bit more out of favor. But the big conglomerate pharmas have tons of cash flow. So they're always, especially when drugs are expiring and patents expiration and all that, they're looking to put money into building whether it's R&D or building their pipeline and acquisitions. But the cost of the regulatory risk is still a concern.
Of course, and actually getting through approval for drugs is so time-consuming and so expensive.
Yeah.
You try to see it from both sides of the fence. Try to understand it from their perspective. They're spending all of this money developing a drug. They have to pay off all of these costs, and then they only have 7 years to capitalize upon it and to market it and make the money before it becomes a generic, right?
Right.
So they've got this window to try to make this money. So, of course, if the costs of drugs are being limited, the costs to the end user are being limited, that's going to impact them. The fact that they seem to be able to sell drugs around the world, they're kind of what's the word I'm looking for? They're sort of giving people a better deal around the world, and Americans are footing the bill for it.
Yeah, that's fair.
Yeah, so sometimes they're giving people consideration. They're giving people lower drug prices. That's why people will run off to Mexico to pick up a particular prescription or something. It's cheaper there. They're getting a more
discounted,
like a discount.
Yeah.
But the affluent country is having to pay for it. So of course, if the government turns around and says, "Well, we're going to try to suppress drug prices," that's going to impact the drug companies, and that's where they're going to not do so well. I'm not saying that everyone's that they're angels or that everybody are angels, or they know how to run their business, and running a business is tough, right?
Yeah, but going back to see, when I hear stuff like this, it's exciting to me because it's mystery, it's a puzzle, it's a treasure hunt, it's whatever you want to call it. I love digging into individual stocks, whether they are energy or tech or biotech or whatever, and it's fascinating to me. It's always trying to, maybe take some of the models of some of the winners in the past and trying to replicate that and find some newer growth companies or newer potential. And
absolutely.
And always saying, okay, well, it was the railroads in the 1920s and the airlines and television and blah, 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 and the internet. And what's the next invention? What's the next crack of our time that has growth?
Computers. Computers.
You're onto something.
Yeah, but some of these companies that when you do find a company that has a great business and it makes perfect sense and it's economical, a couple of things. The first time I remember seeing Ormat Technologies was one that was very interesting to me.
Yeah.
Geothermal. I thought, geothermal, this is brilliant.
Yeah.
I mean, energy 24/7, no topographical impact whatsoever. You drill a hole here, you drill a hole next to it, you pour water down one, and steam comes up the other end, and you keep rotating it. And you've just got infinite amounts of energy for free.
Yeah.
This is brilliant. Why isn't every government in the world plowing money into geothermal? And I guess the answer is because it works. I don't know. I don't know. But I had a lot of geothermal stock, and it just went nowhere fast.
Sometimes we do look, that's part of the challenge.
Yeah.
Is I get excited about some companies and I'm saying, okay, this makes all the sense in the world.
Yeah.
And the stock doesn't agree with me.
Mm.
Or sometimes I don't get the story and the stock keeps going higher and I won't short it, but I'm like, this makes no sense. But that's called the market.
Yeah.
If it was easy and everything made sense and everything was like, okay, A equals B and whatever, everything was so simple, whatever, like if it was just all linear and like it doesn't, that's part of the challenge of the markets.
Yeah, but you have to, that's also why it's so important to evaluate a stock and then say, hey, you know what? I love the company, but the stock is just not performing right now.
Yeah.
It's like you got on a subway train in New York and for some reason it's not moving.
Yeah.
And you need to get to where you're going. Nothing wrong with the train. It's just not moving right now. So get out and get another train.
Yeah.
You know, and other companies like PCT I like a lot. I think that's a great business model, and they're starting to do very well. But it's going to take a while to move, but slowly and surely it moves up and down here and there. I think it's a great company. All of these things are outside of the core of the dividend portfolio and of the index funds.
Yeah.
I mean, this is
So you have
even for me.
You have a portion you're okay with speculation.
Mm-hmm. Yeah.
But as long as it's a smaller portion,
Sure.
responsibly.
Yeah, and that's the same, you know, trading, the same account that I use for my option trading as well. So it's a, you know, it's a mixture of taking positions in stocks, trading some options, you know, playing around with it, having some fun with it. But if I have to go on the road, you know, then I have to sort of shut it all down and say, okay, well, we won't be so active in this particular section. We'll just leave the other stuff to do the churn along on it under its own steam sort of thing.
Yeah. Thank you so much for doing this.
Yeah.
Once again, 99% of our conversation was markets. We didn't even
talk about music.
We didn't get into music. And I was going to ask you about really quick the Black Sabbath tribute. What do you think?
Oh, it was great. I mean, you know, Ozzy is. I was really glad that he was able to do such a cool show to mark the end of a spectacular career. I mean, when you look at that career and the bands that have been influenced by Black Sabbath and by Ozzy and his whole story through it, I mean, it was really remarkable. So, you know, I wasn't there in person, but very much there in spirit. Yeah. And I was thrilled that they played "Shot in the Dark," which was definitely a pivotal song for Ozzy during his career. So that I was proud to be part of that. But it was great. It was great seeing everybody and watching all of that. It was very cool.
That's cool. And one last thing, what are you working on? You mentioned a solo album. What are you working on right now?
Yeah, I've got a solo album that I started actually a couple of months, 2-3 months ago I started, and I pretty much almost finished it now. So wrote songs, put them down. It's all kind of inspired by the angst of current affairs, media, news, the way that this noise is out there. And so that's pretty cool. I might have a deal for it. So
that's awesome.
That's looking pretty good. And I have some other ideas. I want to sort of kind of approach it with more of a social media kind of angle rather than just the traditional release the album, put it out. Yeah. You know, I want to have some fun with it as well. I mean, why not experiment, you know?
You got to adapt to the times.
Absolutely. I mean, look at this different world we live in. It's all about podcasts over TV. TV is nobody wants to watch TV anymore.
No.
You know, and so the world changes, and I think it's a question of being of aligning yourself and being part of the party.
Yeah,
right.
It's always I always mention that Paul Tudor Jones. You either adapt, evolve, or die when he talks about the markets. Right. I think that's like in life. You know, Blockbuster didn't adapt. and they died.
Mhm.
So life's going to throw things, the technology is going to throw things at us, and markets and everything, music industry, and you have to adapt
Yeah.
and try to keep up with or have a little bit of, foresight, clairvoyance on how the industries are shifting.
Mm-hmm.
So I'll leave you with the last words. I can't thank you enough for doing this. So thanks for hanging out, and I hope we can do this again soon.
Absolutely.
I love these conversations.
Yeah, absolutely. And it's great because we can have these conversations without a band playing in the background making all this noise. But no, as passionate as I am about this, I'm more passionate, of course, about music. That's really the reason that I do everything.
Yeah.
And it's the one thing in this world that seems to make any sense. Playing music and writing music and just the hospitality industry, allowing people to have a good time and get away from the troubles of a daily work regime and be able to enjoy themselves, listening to their favorite music, and just, to me, seeing those people, that's really the moment where I feel so great about what it is that I do.
Amen to that. And it brings everyone together.
Absolutely.
In a world that's incredibly emotional and divisive, music is the one thing one of the things that keeps us together.
Absolutely. It is.
Yeah.
It is.
Thank you again, and hopefully we can do this again soon.
Absolutely, Joe. Thank you so much for having me.
Appreciate it.
Okay. Take care.
See ya.